Today, folks, as I've done every week on this channel since I started doing YouTube, I'm going to give you clerical insight into my $387,000 dividend stock portfolio, which is down about several $1,000s in the month of December. We're going to be taking a look at the dividends themselves, which are also seeing a reduction. I'm going to explain to you the factors actually causing this, as my goal by the end of this year is to get over $1,000 a month in dividend income, $12,000 annually, which is going to require me to do some adjustments, some selling, some buying of some positions. I'm going to explain that in this video. I'm also going to go through each one of these stocks just to see how they're doing in the latter half of this year. And then finally, thanks to you beautiful buggers out there commenting, all you wonderful passive income investors in that comment section below, you revealed to me a brand new ETF no one's talking about that yields 4.5%. The dividend is paid monthly and it has zero risk. If that is a conversation you think you'd appreciate, hit that like button, folks. And let's get into this by first and foremost taking a broad view of the portfolio itself. Again, all of the investments today are worth about $362,000 with my 25K cash position. That's where I'm getting the total of $387,000. We can see my dividends over here currently sitting at $11,389. All of this is adjusting because it's converted to the Canadian dollar value. And many of you know at this point, the US dollar has been falling off. So that means all of my US investments, all of my US dividends, if I decide to convert them to the Canadian currency in my native currency, I am going to start seeing a reduction. So that starts to hinder and hurt the overall portfolio. But I do appreciate the 50% exposure to the US and about 50% exposure to Canada. So it ends up balancing itself out. We can see for the month of December thus far, I have received $676 in dividends, a total annual income thus far of $10,774. We are expecting more dividends for the month of December coming into January from SCHD, VYM, and I do believe VOO is going to be paying out fairly shortly. But what we're going to do is break down each one of these positions, where they currently sit, how I'm going to be pivoting them to bring this yield up closer to $12,000 annually, and then finally these zero risk ETFs. But first and foremost, I want to say thanks to everybody that has supported me by purchasing my portfolio tracking spreadsheets. We just launched the one for Google Sheets. We had the one for iCloud, which you see on the screen here, and we're going to be launching one for Excel very shortly. If you have purchased any of the priors, you get all the new ones for free, plus any patches or fixes we're currently working on, you will get those updates for free as well. They're only $12.99, and I greatly appreciate you supporting the channel. So let's get into this with first and foremost VDY, which currently has been pulling back. And as I mentioned, guys, I've been primarily focused on stacking cash because I don't trust this current rally, and it's already proving to start pulling back. And I do plan on actually purchasing a little bit more VDY before the end of the year. The current yield sits around 4.25%, and we did receive some of those dividends already from VDY, which pays out toward the beginning of the month. Taking a look at SCHD, the Schwab US equity dividend ETF, this one not performing as well as VDY. It's currently down 5.36%. Taking a look at the dividends here, this one's yielding about 3.35, so it's down about 2% if you calculate in the dividend for the year. This one I haven't received the dividends for just yet, but it should be coming. And it's neat to note that all of these ETFs tend to trade well below the S&P 500 value because the PE on SCHD is around 15.6. And I should point out that the PE for VDY is only sitting at 11. So these are exceptionally low value plays in my humble opinion. But taking a look at VYM, the Vanguard high dividend yield ETF, this one's only down 1.96% year to date as it stands in the midst of December. And the dividend yield not as attractive at 2.89%, but it is actually outperforming the other dividend ETFs here. Current PE on this one's 14.4, and we are expecting toward the end of December to be getting a nice healthy yield from this one as well. A nice payout there. The Vanguard S&P 500 index and comparable right now is down about 17%. And again, the yield on this, again, we're not buying this typically for payout because the yield's only 1.58%. The PE is currently sitting about 19.5. And again, we should be expecting a payout toward the end of this month. Now, finally, the only other two real big positions in my portfolio are my REITs, and these things have proved to be fairly resilient, even though these aren't fast growing companies. They're just kind of boring, but you're kind of just holding these for that exposure to the Canadian real estate market. And Riocan, my favorite REIT of all time, guys, down 8.82% year to date. You tap on the 5% dividend, it's down about 3.3 to 4%. Same with Smart Centers here. Smart Centers is yielding a whopping 6.8%. It is down 14%, but again, you plop on that yield, it's not really that bad in comparison to the S&P 500 this year. Now, when it comes to how I'm going to pivot the portfolio slightly, as I am going to be making a little bit more extra money toward the end of this year, I'm basically going to be looking into my TFSA to perhaps pull about 10,000 US out of VOO just so I can put it a little bit more into SCHD and VYM, get them up to over 10%, giving me that total 50% exposure to the US markets. Because you can see currently I have about 135,000. Again, that's converted the Canadian currency in VOO. I've got about 33,000 in SCHD and about another 33,000 in VYM. So that'll balance it out slightly and just slightly bump the yield overall. And as I mentioned, I'm going to be taking about $10,000 very soon toward the end of this year and dumping it into some GICs, because these GIC rates are going to go up again thanks to the December rate hike, and that's going to get reflected here probably in the next couple weeks. So if I can get over 4%, 4 to 5% within a year, I'm probably going to take advantage of that. The bank did mention that you can get a 24-month cashable GIC at 4% even, which sounds very nice to me. But one of the coolest investments that you guys have mentioned to me that I'm looking into currently, I haven't bought them because I'm still learning about them, trying to figure out exactly how these operate, is these cash-focused high interest rate account ETFs. So what are these and how do they work? Well, this is the Horizons Cash Maximizer ETF. We're going to look at a few others as well. We can see this chart looks amazing, but we're only talking about a 3.83% movement over like the last 3 years, but we're not buying this for growth. We're buying it purely for security. And just reading into the investment objective, HSAV seeks to generate modest capital growth by investing primarily in high interest deposit accounts with Canadian banks. So they're just going through all the Canadian banks, finding the highest interest paid accounts and just depositing your money in there for you. And just taking a look, guys, the expense ratio and just the income on these are very fascinating, because I always tell you, don't buy an ETF that has a 0.5% expense ratio. It's just way too high. The Vanguard ETFs can be anywhere from 0.01 to 2 roughly. I mean, with the VDY is like one of my highest expense ratio ETFs at 0.2, and these ones have a management expense of only 0.12%, so it's very low, and the current yield on this is 4.75%, even better than a lot of GICs and bond rates, which is really intriguing because that gets paid monthly, which is just staggering. But just taking a look, here's another one from Horizons called the Horizons High Interest Savings, which is under the ticker symbol CASH, and we can see this one every time it pays out, it drops off a little bit. But just taking a look at this one, the expense ratio is 0.13% and the gross yield is 4.79%. So the yield on that one actually I think is slightly higher than even this one. But let's just take a look at one more, because there's also the Purpose High Interest Savings ETF. And again, these things look really volatile, but they're not at all. These are very tiny movements that are just based out that monthly payment. But just taking a look at this one, also very intriguing here with a yield of 4.59%. This one seeming to be more focused on purpose premium money market funds. All of these are very safe, low risk investments that I find very intriguing. I have one minor concern with these specifically is the volume, because a lot of people don't know these exist. If we actually just go into Yahoo per se, let's just see if we can pull it up here. You'll take a look at the trading volume, and the reason the trading volume matters, which with this one specifically, we're seeing about 21,000 shares traded, which offers a little bit more liquidity, but it's really low compared to regular stocks. So if you put $1 million in here, I'm curious if I could pull out $1 million immediately without having, someone else having to buy the stock, because the volume's not high. You could be sitting for days waiting for the trade to close. So I might actually call these ETF providers up just to see exactly the risk exposure, how to get out of them safely. And I'll probably actually end up adding some of these with my cash positions, because my current savings rate on Bank of Nova Scotia is at like 2.8%, which is like, about half as much as I could get off one of these ETFs, which is just fascinating. Now, just encompassing everything we've talked about here, from getting the dividend up to over 12,000 annually, first and foremost, guys, by selling VOO and buying a little bit of SCHD and VYM, that should boost my dividend by about 150 US, maybe around 200 CAD if I'm lucky. I'm going to be adding a little bit more VDY, as I'm going to have some contribution room to my TFSA at the beginning of the year, about 6,500. That'll probably bring it up another couple $100. If I put 10,000 into a GIC at 4%, there's another $400. And if I use a little bit of the extra cash I have remaining to securitize my portfolio by putting that into one of these ETFs at 4.5% paid monthly, which is just awesome, guys. That's going to be bringing me up maybe just another couple hundred or few $100 if I just even throw 5,000 in there. All of that combined should raise the dividend between, I'm going to say 700 and 1,000, depending on what the US dollar is doing and just depending on a few other variable expenses I may have at the end of this year. But you plot that on with the 11,400 I'm roughly making already, and that'll just put me over my goal of primarily making 1,000 a month off ETFs and very sound, safe investments, so we can start riding through the volatility coming into 2023. So at this point, I'll pass the question off to you. I'd love to know what you guys think about this in that comment section below.